Welcome to this lesson on understanding supply and demand. In this unit, we will examine a core concept of economics, supply and demand, and learn how the actions of suppliers and customers can influence the viability of a business. Supply and demand are both key to economic activity. The two influence each other and impact prices of consumer goods and services within an economy. Understanding the specific supply and demand issues affecting both the sales and purchases a business makes can help it make more informed and smarter business decisions. Suppose you have been buying one 300 milliliter bottle of water for $6 every day. One morning you find that the price has gone down to $5, so you are enticed to buy 2 bottles. The next morning the price of water goes down to $4, and you are tempted to buy 3 bottles. As the price goes down even further, you buy more and more, as you can see in this table. Finally, when the price goes down to $1, you buy 6 bottles. Now think about it the other way round. Every day you have been buying 6 300 milliliter bottles of water for $1 each. One morning you find the price has gone up to $2, so you are only willing to buy 5 bottles. The next morning the price goes up to $3, and you decide you can only afford 4 bottles. At that price. For the sake of argument again, suppose the price goes up to $4 and you buy 3 bottles. When the price is $5, you buy 2 bottles. Finally, when the price reaches $6, you buy only 1 bottle. To summarize, when the price goes down, you are more willing to buy more of a product and vice versa. When the price goes up, you reduce the quantity you demand. This principle is called the law of demand. The law of demand states that there is an inverse relationship between the price and quantity. When the price is increasing, the quantity demanded is decreasing, and vice versa. The law of demand explains the behavior of customers when they are faced with changing prices. When the price of a product or a service changes, the quantity demanded changes in the opposite direction, which is illustrated by a movement along the demand curve. When you observe movements up or down the demand curve, you know there are changes in the quantity demanded. Changes in the quantity demanded, caused by changes in the price of a product, are represented graphically by movement along the demand curve. It can help you to remember this idea about supply and demand. The Greek capital letter delta means a change, so delta P means a change in price and delta QD means a change in quantity demanded. You can read the shortcut as, a change in price causes a change in the quantity demanded, which implies a movement along the demand curve. Remember also that, the law of demand states that when the price is increased, the quantity demanded is decreased, and vice versa. There is an inverse relationship between price and quantity. When the price of a product or service changes, the quantity demanded changes in the opposite direction, which is illustrated by movement along the demand curve. A change in price causes a change in the quantity demanded, which is illustrated by a movement along the demand curve. And what else can affect demand? Let's consider what else might affect your desire for a particular product or service, such as a can of Coke. Point F, for example, shows that you are willing to buy 4 cans of Coke at $3 each. If the price changes upwards, the quantity demanded goes down, and vice versa, which is seen as movement along the demand curve. There is nothing new so far, but now things get a bit more complicated. Let's consider price and choice. You notice that the price of a can of Pepsi in the same market is $1.50. For the price of 1 can of Coke, you could get 2 cans of Pepsi. Consequently, it is reasonable to expect that you will reduce your demand for Coke. We assume here that you are one of a number of customers. We also assume that customers do not have a preference for one brand over the other, in which case the alternative product, Pepsi, is called a substitute. With these assumptions, we can say that customers will buy cans of Coke only when the substitute, Pepsi, is not available at a lower price. So, what will happen to the demand curve in this case? Instead of moving along the curve to indicate a change in price, we have to change the demand curve itself to show the change in demand. The dotted black line in the chart is the original demand curve for Coke. The solid red line shows the new, reduced demand for Coke when the alternative, Pepsi, is cheaper. The solid green line shows the opposite case, when a can of Pepsi costs $3 and a can of Coke costs $1.50, and there is a corresponding increase in the demand for Coke. This example shows that non-price factors can cause a shift in the demand curve. Non-price factors are everything except the price of the product itself. They may include the price of substitutes, customer preferences, income, the number of customers, climate change and many other influences. Examples can include incomes, customer preferences, price of related products, and the numbers of consumers in the market. Now let's look at the supply side of the market. In any market, supply represents the other side of the coin to demand. To understand the supply side, you take almost everything you learned about the demand side and turn it upside down. You have already seen how customers dislike price increases, and how this dislike is reflected in reductions in the quantity demanded. On the other hand, suppliers like to see an increase in the price of their product, and their liking is reflected in an increase in the quantity supplied. When the price of a product goes up, more of that product is made available in the market. Let's look at an example. Now suppose you have been selling one 300 milliliter bottle of water for $1 every day. One morning you find that the price has gone up to $2, so you are enticed to sell 2 bottles. The next morning, the price of water goes up to $3, and you are tempted to sell 3 bottles. As the price goes up even further, you offer more and more for sale, as you can see in the table here. Finally, when the price goes up to $6, you sell 6 bottles. In short, when the price of a product goes up, you are willing to supply more of it and, vice versa, when the price goes down, you are willing to supply less. Let's look at a chart to illustrate this. The blue line in the chart shows how you behave as a supplier. Such a line in economics is called the supply curve. When the price increases, you offer more for sale, the quantity supplied increases. This is called the law of supply. The law of supply states that there is a direct relationship between price and quantity. When the price is increasing, the quantity supplied is increasing. The law of supply describes the behavior of suppliers when they are faced with changing prices. Suppliers have to decide how many products they are willing to supply at any given market price. These decisions are represented by the points on the supply curve. As you can see from the blue line in the chart, when the price is $1, you are willing to supply 1 unit of the product to the market, but if the price is increased to $2, you will supply 2 units of the product and so on. Remember, when the price of the product or service changes, the quantity supplied changes in the same direction, which is illustrated by movement along the supply curve. When you observe a movement up or down the supply curve, you know there is a change in the quantity supplied. When a change in the price of a product causes a change in the quantity supplied, it results in a movement along the supply curve. Note, a movement along the supply curve is caused by a change in the price of the product and the corresponding change in the quantity supplied. The Greek capital letter delta means a change, so delta P means a change in price and delta QS means a change in quantity supplied. You can read the shortcut as a change in price causes a change in the quantity supplied, which implies a movement along the supply curve. Also remember, the law of supply states that when the price is increased, the quantity demanded is increased. There is a direct relationship between price and quantity. When the price of a product or service changes, the quantity supplied changes in the same direction. A change in price causes a change in the quantity supplied, which is illustrated by a movement along the supply curve. Let's now consider what else might affect your willingness to supply a particular product or service. If there are more firms producing the same or similar products to yours, there may be an oversupply in the market. In this case, increased competition may cause you to reduce supply. In the current digital age, new technology is being introduced to enable cheaper production methods. Lower production costs for a product will increase the supply of that product. For example, new software used to be delivered on a CD or DVD. Now software licenses are offered online, and new software is downloaded directly to your computer, tablet or smartphone. This cuts the supplier's production costs, increases productivity, and increases supply. The expectations of suppliers can also affect supply. For example, If news of a new version of Apple's iPhone is leaked to the media, Samsung might reduce the price of their smartphones to increase their sales before the new iPhone is released. The supply will be increased or decreased, depending on which of these factors apply and how they influence supply. In the chart, the dashed blue line is the original supply curve, and the solid red line represents a new, reduced supply. This reduction in supply could have been caused by increased competition, or by increased input prices, making the production more expensive. The solid green line represents a new, increased supply. An increase in supply could have been caused by reduced input prices, or by increased productivity. The law of demand says that at higher prices, buyers will demand less of an economic good. The law of supply says that at higher prices, sellers will supply more of an economic good. These two laws interact to determine the actual market prices and volume of goods that are traded on the market. In this unit, we saw that customers react negatively to price increases, but suppliers react positively to price increases. When the price increases, customers reduce the quantity demanded, but suppliers tend to increase the quantity supplied. The relationship between price and quantity is considered negative for customers and positive for suppliers. Subscribe now and join us in your career journey. Want to learn more? Click on one of our websites to view our range of online business and management courses.